Hello, everyone, and welcome to another episode of The Long and Short of It. I'm Patrick Ceresna.
Nick Galarnik.
All right, Nick, it's been a couple weeks, and what 2 weeks of a gap, right? Like when we last recorded, the S&P 500 was at like 6,100 up along the highs, and we've had quite the 2 week little market dump on the downside, and it certainly has changed the market environment. And while we can get into the technicals of where the S&P is and the macros of why it's there, but it certainly has had an impact on the options market. And this is a show where we dive into the options. We saw
Absolutely.
spikes in volatility and all these things. Actually, we'll get to the volatility part in a moment, but I'll first give my little 2 cents, and then you can tell me what's your take on the market. But here, the S&P, at least for the last few days, has been every rally has failed. It's been just modest little bounces in the market. It rolls over and sells again. And I'm not surprised today is a little bit more of a quieter day because we have the jobs numbers coming out tomorrow. And I think that the market could really either have a high conviction move starting after the jobs number, whether it's a breakdown in the markets or a rally. So not surprised in that, but it has been from a market correction perspective about the depth of prior market corrections. Only the yen carry trade unwind was a more volatile stock market event than the current one. And so, it's a really interesting moment to find out whether this is a buy on dip or whether this is some kind of bigger bear market that has got underway. How do you size up the situation, bud?
Well, we discussed this a couple of weeks ago, and I was saying that I think we touched that 5,800 level on SPX, and we've already breached that. We're right there right now, pretty much. Um, I'm very, very cash heavy right now because I'm apprehensive about going along most things. The one idea that I do have, which I like a lot, is Google, and we'll discuss that later on in
Yeah.
the show. But right now, seasonality isn't in favor of a bullish trend right now. We're right at the 200-day moving average on the S&P, so a balance would probably make sense. That being said, it might be short-lived. So, looking out for the next 4 weeks or so doesn't give me a lot of enthusiasm to go bullish. However, we do know that markets do get bid back up typically when we see these oversold corrections, roughly. However, looking at SPX, we're only down about 6% from all-time highs. NASDAQ, we hit that 10% mark already. So NASDAQ is much, I would say, much more in correction territory than S&P. But in the short term, I think that we see kind of like a mini bounce, perhaps like 5,900, maybe 5,950-ish, before we see a drop down below 5,700. And the reason why I think this is because given what's happening right now in the political climate with Trump coming out and saying these things about tariffs and other issues he's talking about, it's creating a lot of uncertainty in markets. And as a result, many participants can't enthusiastically place their cash and deploy their cash and say, I'm going to go long a bunch of names, because you don't want to, look at your portfolio in the morning after waking up and see you're down 10% on a bunch of names because of some headline. However, looking back at what happened during Trump's first term, if everyone recalls in our audience, the China trade wars. So back then we would have a headline come out, market would sell off. A couple days later, some kind of resolution would come out, or headline resolution would come out from Trump or someone in his staff. Market would rally back up again. So we're in this kind of cycle of, headline news, market sells off, wait a couple days, more volatility, more fear, then some kind of resolution, pops back up again, then wait a few more weeks or a few more days, rinse and repeat, the same kind of cycle. So that isn't really lending to enthusiastic long side buying. And my opinion is that we're going to see a artificially induced recession because of what's happening right now. Because when you think about, tariffs from the US on Europe, Canada, Mexico, China, a lot of your goods in the US come from those countries. So inflation should rise. And there could be two reasons for this. It could be, one reason could be that Trump wants to see rates brought down to 0%. Yeah. That's a possibility, which is why he's trying to induce a recession. Keep in mind, people behind him like Elon Musk, they're more savvy than he is, perhaps. But the whole idea is that they want to engineer a recession to get rates down to 0%, essentially, or near zero. That's what he ultimately wants. And in order to do that, he has to kind of facilitate all this turmoil to cause unemployment to go up, to cause inflation to go up before that happens, right? So that's just kind of my 2 cents right now.
Yeah, the um, I hear you in terms of like the Trump effect, but I think that there's a perspectives you have to put in. One is the day-to-day volatility, and your point about reaction to everything Trump that comes out of Trump's mouth is going to have that very quick reactions in the market that create the extra volatility of the swings higher and lower. But then there's exactly like you were suggesting, the impact of on the economy from what the policies being implemented are, and then what is the path of the markets. And the one thing that I will say is that when you say induced recession, I agree with this because the one characteristic of bear markets almost always is some degree or another of earnings contraction. Sometimes you'll see the earnings of these companies dropping 30, 40% of the on the S&P 500 during a real economic slowdown. We just didn't see that in the last couple of years. Up
No.
until now, the earnings have been great. And the question is this as they tighten their belts for this business volatility of uncertainty of how trade around the world is going to be impacting everyone, it's going to be very interesting to see, obviously, what impact this has on consumer confidence, on business confidence, and whether that does induce an earnings contraction, because that's where the stock market, in my opinion, would have the deepest risks on the corrective side, on the downside. It is also interesting, like you were saying, the Nasdaq obviously out from right here. I'll just put up the charts here. Like Nasdaq has been from peak to trough the far more volatile. I mean, you're talked about that 10% decline there, and we saw a lot of that come from the Mag 7, and from their Mag 7 peak. This is the ETF of the Mag 7s. We've already seen an 18% correction. Now, the correction from where the Nasdaq peaked, which was over here, result in about a 14% correction. We're talking about the seven largest companies in the Nasdaq and in the S&P 500, essentially, and their magnitude of their drop and the velocity of their drop is actually far greater than that of the broader market, and that certainly has been a huge contributor to the lot of the uncertainty, because I would say the majority of retail investors and hedge funds had to own these Mag 7s in order to get market participation. And so they're the ones now kind of feeling the most pain. And that's where a lot of the negative sentiment is really coming from on that front. Anything you want to add, or are we going to jump
Yeah.
into the
I mean,
Google?
a couple of things, for one, as I mentioned previously, the historical market PE right now, the Schiller PE ratio is at like 37 right now.
Yeah.
The average over the past 100 some odd years is what, 17 or so. So we're more than double the average right now. So stocks are historically very expensive. And then the other thing too is that the Mag 7, every single one of them fell on their earning reports. When you think about their business models overall, most of them do not do well in an environment with inflation being higher. Because think about this: if we have tariffs in the US on most of their imports, that means that cost of goods are higher, cost of services are higher as well. Spending slows, retail spending goes down, consumer confidence goes down as well. You have names like, for example, Meta and Google, which we're going to discuss shortly, that both rely heavily on advertising. Now, if people aren't buying goods online, for example, because they're watching their spending, that means that advertising spending should
Yeah.
decline as well. Then you have Amazon, which is, a lot of their business comes from obviously shipping goods and services, but also cloud, right? Now, if companies are cutting costs and cutting headcount, that likely means that cloud spending will also slow down as well. So they can hit Amazon too. Apple is pure consumer discretionary. They have no innovation right now. I don't see how they're going to keep on doing, so well going forward in the next, year or so. That's just my perspective on Apple. They could obviously come out with some amazing new product, and that would change my perspective overall. But right now, their PE is like
No.
38. It's almost double their average as well, right? So like everything's expensive. The only name that I think is cheap right now, which we're going to discuss, is Google. And the reason why I'm liking Google is because they're cheap historically against their averages and relative to their peers as well.
Right. And before we get to your trade idea, because I think you're trying to fade this theme, though, I'll play a little bit of a bounce on Google, but I wanted to just touch on volatility. So, just quickly looking at the chart here, we have the volatility index spiked up to about 24. And so I want to, for our listeners that are less familiar with volatility in options pricing, what determines an actual value of an option is about its probability of distribution. What is the probability of going higher or lower, which is anchored off of the implied volatility that is expected of the security. So when we're looking at this chart on the VIX, it's telling us what the implied volatility of the whole S&P 500 is. And what we literally have seen is almost a doubling in the value of the VIX over the span of the last 2 weeks. We went down from trading in the 13, 14 level on the VIX to being as high as 26 on the VIX, and so we've seen volatility materially rise, which for at least 30-day options has caused the volatility premium, or the premium that you're paying for the option, to considerably rise in its cost. What's interesting about this, Nick, and I'd love to get your take on what you're thinking of it, is that long-term volatility. Let's just go on leaps, like a one-year vol index. We're right now at 22, but the rate of change wasn't that crazy. We've gone from about 20% to about 22%. So there's only been about a 10% rise in volatility premiums on long dated options. And so when one tries to interpret whether options are much too rich or too expensive to speculate long gamma, obviously we can do spreads and other combinations. But when you're talking about whether you're getting asymmetry for going long straight up a call option at these prices, you're paying a bigger premium for that shorter dated option. But when you're looking at for long dated options, you can still take very reasonable long dated positioning on your views on the market, and it's not a gross overpay in my opinion. A 22, like taking a couple Vega points risk, is not a stretch at this moment for if you wanted to take a long-term positioning. But now you are like the intraday short-term trader, and one thing that I wanted to talk about and have your comment on is what's happened with short-term volatility. Now, this is the VIX for one-day options, and you live in the zero DTE world, where these very short-term options are your thing. We saw volatility when the market was at its tops, down daily volatility as low as like 7, 8, 9%, like single digits. This is now skyrocketed to like 25%. These daily options have these huge, big, rich premiums. What's your take on all of this, and what are you doing here?
Right now, if you look at the straddles each day, so the straddle is whatever, for example, the spot price of SPX opens at. Let's say that it opens at 5,800 as an example. The straddle would be the combined cost of the at the money call and at the money put for that same day expiration. So in normal times when the market's pushing, new all-time highs, volatility is contracting typically, and you're looking at, an intraday move expected of around, let's say like 35, 40 points, which means that the straddle would cost about 35 to 40 points. And right now with the volatility elevated, you're looking at these straddles that open and you're seeing like 70, 80 point straddles at open, implying that we're going to move 80 points from the opening print that same day. And so you're seeing this whipsaw action happening a lot, where we're perhaps selling off heavily in the first half of the day, and then after Euro close, we're seeing a rally into close here, and or you're seeing for example a rally first half of the day, and then a sell off into close. You're seeing a lot of volatility, which is not typical, right? Like
Yeah, yeah.
the last year and change hasn't been volatile at all, really.
Right.
So now actually it's more of a premium seller's environment. There are players out there that are selling a lot of premium on 0-day options. There's one that I've been tracking who's selling iron condors every day, $5 wide at the 20 delta roughly, pulling in a credit of about $2 with 3 at risk. And the interesting thing is that it's actually pinned his strike price 2 days in a row the past couple of days. Like I have the data over here. Let me just pull it up one
Yeah.
second. So he had, for example, a couple of days ago, his short strike was 57.80 on March 4th. That was a lower strike. We finished right around that strike. Yesterday, his upper strike was 58.40. Where did we finish yesterday? Right around that strike, 58.42. So interesting that we're seeing the prices push toward these strikes. And it makes sense because the market doesn't like giving people free money. If it worked that way, everyone would do this and make money every single day with high
Yeah.
probability, right? So it makes sense that it might test out both sides. When you see these massive positions in SPX, for example, on 0-day options, where you're seeing these like huge number of spreads or condors being sold, or I guess bought, if you want to call it that, because when you're buying a condor, you're actually opening a condor for its intended purpose. If you're selling one, you're actually closing it out. But regardless, the whole idea is that you're betting on the market staying in a certain range. So today, for example, you might bet on it staying between 5,900 on the upside and the downside, 57.40, for example, right? So 160 point spread, you would think that, okay, if it closes in that range, I make maximum profit. But what usually happens is that it'll move toward the lower strike to push out the bottom position, and then move toward the higher strike to push out the top position as well, right? I
Yeah.
experienced this a lot when I was trading condors back in 2022 during the previous bear market. It was a phenomenal strategy. It worked really well. Like I won like 94% of the time. Great strategy overall, but you need to know how to manage your risk. Now going with these 0-day options, I think market makers have kind of wised up and they understand what's going on, because back then, if you recall, the CBOE released 0-day options every day of the week starting in May of 2022, I believe it was. So only at that point in time did it make sense to use this strategy, roughly, right? So
Yeah.
I got off on a bit of a tangent there, sorry, but yeah.
Yeah. But anyway, we definitely have higher volatility on an intraday basis, and what's particularly interesting, I think, is that there's going to be even higher volatility for tomorrow's 0 DTE with that jobs number coming up. It's betting on that option. There's almost certainly, at least inherently built in, some sort of market volatility for tomorrow. It'll be interesting to see how it plays out. But okay, like Nick, let's talk trades, because it's your turn this episode to come up with a idea to share that we can talk about. And you were mentioning to me Google, so like, what's on your mind, here, bud?
So two things. So before we talk about Google, one thing too is that if you recall a few months ago, one of your trade ideas actually has panned out very well. That I think it was the March OPEX SPY put spreads. Remember we were so much $5 to make like $95,
Yeah,
something like that. And right now they're printing. So just an interesting
yeah,
observation. But yeah, with Google, my rationale here is pretty simple. Their current P is 22. Their forward P is 17, roughly. They're a very profitable company, one of the best companies on earth. And against their peers, they're very, 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 very cheap, right? So I think Google is a great buy here. Not to mention they're trading near their 200-day moving average as well on the charts. So if you pull up their charts on
yeah.
the
Here,
screen here, you can
I'll
see,
put the
yeah,
I'll put the 200-day on here. If I could type, there we go. Look at that. All right, it's trading right at that 200-day.
yeah. So this has typically been a great opportunity to buy Google when it hits the 200-day moving average, roughly, right? So like previously went down to 148 in September-ish. What happened? It ran from 148-ish, I think at the low roughly, to a
Yeah,
high of like 210 in the span of 6 months roughly, or 5 months actually. So looking at asymmetry of risk, which is my perspective on taking positions, when I see this opportunity arise, I say, okay, Google is cheap right now relative to its historical valuations, to its peers. And right now in the market, there aren't many names I want to touch. Names that have physical products or goods, for example, they're at risk due to tariffs, right? Obviously, I mentioned previously that ad sales, which comprise a lot of Google's revenues, um, could be affected for sure. But I'm not looking at it, in the very, very short term. I'm looking at more midterm to long term. I'm holding leaps and shares longer term. That being said, in the short term, I think we can see a bounce toward that like 190 area, perhaps.
Right.
And right now, given that I'm bearish on the broad markets for the next couple of weeks, it doesn't make sense to really go out, till April OPEX. So I'm looking at the June OPEX on Google, and right now the um 180 200 call spreads are trading for about $7 or so. They were about 550 yesterday. So yesterday they were 550, risking 550 to make a maximum profit of 1450. So about 3-to-1 risk reward.
Right.
And the reason why I went out of the money is because if I'm incorrect and we fall further and the market sells off more and Google falls to that 150 area, I don't want to be wasting a lot of cash on a short-term position and having it burn up. So
Right.
you have a stop loss in place there at half the value of your entry price. So if, for example, you're in at $7, your stop loss is at 350, right? But what could happen is that if we see a bounce in markets after the March OPEX, which is in 2 more weeks, that may cause a catalyst for Google to push toward that 190 mark again, in which case you can monetize a position and de-risk it as it goes more profitable overall. And the reason why we're using a spread, because as you said previously, with the VIX elevated, option prices are more expensive. So you never want to be buying typically calls or puts when the VIX is elevated, because you're paying a much higher premium
Yes.
relative to the historical averages. And when that happens, if you're buying when options are expensive, your probability of making a profit is much, much lower, because you're not only fighting time, you're also fighting direction, and you're fighting the implied volatility crush. If the market rallies higher, what happens? Fear abates a little bit, and so option prices decline as a result of this, right? So you can get hit in numerous different ways. That's why using a spread in this case. Why I capped it at 200, because again, I don't think it's going to go back above 200 by June. But June gives you also the earning event in May as well. Early May they'll have earnings, so there are numerous catalysts for this to be a good play overall. It's not a crazy, like a massive home run trade where you're risking, one to make 10,
Yeah.
for example, but you're risking roughly, one to make 2.5 right now or so, because you're risking 7 to make 13 or so, right? So,
I love the play. I will just kind of put it into my frame and some of the things that I would consider if
mm,
I was putting it on myself. First of all, uh, typically the decision has to be made in my mind is to whether I believe Google's a buy on dip for a resumption back up toward its previous highs in a bull phase that obviously can span 3 to 6 months forward, hence why you would go to June and you would play that longer term. Or are you playing a bounce? And a bounce, like for instance, typically 50% retracement of a prior decline could easily see the stock Google trade back to 188 to 190 on the upside, which is a retracement zone of its prior decline. The
mm,
thing is that a bounce, let's say back to 190, can literally happen within a week or two.
absolutely.
You don't need 3 months of time
Yeah.
on a position, and so you have to make a decision as to what you're looking for. You're looking for that bull trend to resume, and you need to have enough time to capture a move back up to its previous highs, or are you thinking that, like I always describe it, Nick, that's like a bungee cord tied to someone's feet off a bridge.
Yeah.
When it gets stretched too far, it's
Pulls
going
the-
to snap back the other way.
Yeah.
In the same way, if if all we're looking for is that bungee cord reaction the other way, I think June is not going to give you the big delta kick from their net, because you're going adding time, and that's I think one important thing to always consider for our listeners that are brand new to spread trading, is that you can only ever experience the full payoff of the spread at expiration. And
Yes.
so so if you have the tendency to close the position early once certain price targets are hit, the how much of that payoff profile you've achieved has a lot to do with the duration of the spread. If you go open a 1 year spread, you're going
Yeah.
to have very little reaction to it. While if you open just like one with 2 weeks till expiration, you might be banging off the full profit. So one big consideration for me is what is it that I'm looking for from Google? For me, I feel much more confident in a retracement back to 190 than I
Mhm.
am on a resumption in bulls. So if I was to put on this trade, I would, like, a way I almost look at it is, if this jobs numbers uh, don't come in for a reaction and this market doesn't bounce, I wouldn't want to be in this trade anyway. Like, dabbling with the bull call spread between 180 to 190. Here, I just have the options chain for just 2 weeks out
Mhm.
till March 21st. It's basically 320 against let's keep it 70 cents for simple math.
About
But
230 roughly.
yeah, so you're talking about having a $2.30 outlay for a $10 wide spread,
Mhm.
and it's a small capital outlay. Either the thing bounces and gives you a half decent payoff, because that at least gives you the chance of realizing the majority of that $7.50 upside, if the bounce occurs. And if not, the $2 paper cut is you could even take a full zero on it.
Yeah, what
And
matters.
it's
Yeah.
it's a small enough outlay where you can just size the risk to zero expiration value at that. And so for me, I love your idea. My angle would be that I'd play the
Shorter
bounce.
term. Yeah, yeah.
Yeah,
No.
I
Yeah.
would play the bounce.
See, I understand your perspective entirely, and this is what makes this such great, like, dichotomy of our views. Um, the only issue with me right now is that I think that we're still going to be bearish the next couple of weeks into March OPEX. So that's why I'm apprehensive about going very short term into that OPEX. If for example, we're fast forward, we're fasting, we're going fast forward 2 weeks out, and we're past the March OPEX, and we're still where we are right now, that would lead me to say, okay, maybe go to April, for example, for a bounce. April OPEX for the same kind of call spread, 180, 190. But because I'm bearish short term, I don't want to share on the show that, I'm taking a short term trade when I don't actually believe we're going to perhaps bounce in the next 2 weeks. I think it'll happen after 2 weeks are up. So if you're listening, thinking about ideas here, obviously everything we discuss here is for fun and for educational purposes. But my perspective is that short term, I'm bearish into the March OPEX. Thereafter, I'm bullish short term into like the April OPEX. Um, Google, I'm bearish on long term. So that's why my idea right here is for June, because I'm incorporating the earning event, which may be a negative event perhaps, and we fall further. Yes, that's a great point. Asymmetry risk isn't as great as a short term trade for sure. I mean, for all we know, the report tomorrow, tomorrow we have the, what is it, NFP, right?
The non-farm payroll.
Yeah, NFP report is tomorrow morning, right? So tomorrow, if it comes in, uh, positive, if you want to call it positive, which I don't think it will be, but if it comes in positive, then and we see a massive bounce of 2-3% on a Friday, Google could be at 185 tomorrow, for example, right?
Yeah.
And that's where you monetize a really nice short term call spread. Again, it really depends on your time horizon, your thesis directionally, what the overall macro dynamic is in terms of applied volatility for both the market and the individual name. In this case, every name is very, very expensive option
Yeah.
wise. So you have to use spreads pretty much. Going short term can be very, very lucrative, of course. But if I don't believe that we're going to see a bounce in the next 2 weeks and we're going to see a bounce thereafter, then going short term doesn't make sense for me overall.
So now, let me just kind of go through an alternative scenario of just kind of talking it through, because you discussed the idea of putting a stop loss associated with that June spread.
Yeah.
Now, I haven't run it through a simulator, especially with the vol spike, but uh, I would imagine there's at least a chance that you're going to be challenged on that stop if Google heads towards 150
Yeah, for sure.
on the downside. And so let's say hypothetically there's a risk that there's a stop out where you might have to sideline yourself for $3.50 risk. The other dynamic is that, well, if you took this $2 outlay for 2 weeks and it ended up being wrong, and you, let's say, recovered 50 cents or 25 cents on you were able to scrap something out, but took at least a buck and a half loss on the thing
Yeah.
from a loss perspective. Well, then you have the tactical ability to, when the thing's down at $150, to open a spread, let's say starting at 170 to 180 versus being up at 180 to 190 or
Yeah.
180 to 200. It allows you to reposition. So even though you were dead wrong on the first spread and took a very clean loss
Mhm.
on the position, you're almost at a situation where you have the optionality to reset yourself. It's like a mulligan in golf, where you,
Yeah.
you lost the ball and you have to accept the loss,
Yeah.
but you have the ability to reset up the trade anew. And
Absolutely.
that's always has to go into the calculus of how you approach trading, right? One way or another, at some point when the market bounces, Google's going to bounce. This is a given.
Yeah.
It's a very it's correlated with indices very clearly, and the markets are very oversold. And let's find out what happens here, bud. Like, it's going to be really interesting. Any final comments you want to make before we wrap up today's episode?
I would just say that for everyone listening, um, manage your risk very, very well, especially in these environments. Like I see people blowing up their accounts, like in different groups that I'm part of, and it's asinine to take astronomical risk when you could just manage your risk and take small bets here and there with the high symmetry of risk. If you lose, like Patrick said, you get a mulligan, move on to the next trade. But taking these full port positions where you're watching people just like full port into 0 day options, I'm always flabbergasted when I'm on Reddit and I'm seeing guys post like I lost 500K in one day, and I'm like, how do you do that? To me it doesn't make sense at all whatsoever. You can manage your risk and make good money in the markets, and markets will be there, um, you know, forever essentially. So opportunities always abound, and if you don't find a good setup today, wait till tomorrow, right? So
Yeah,
manage your risk and
that's Yeah, I agree with you 100%. I just want to add that, like, the interesting part about the markets is the markets get to be whatever you want them to be. So to Warren Buffett, they're companies that he owns for the long term. And, for a technician, it's a short term move of momentum, and for a zero DTE trader, it's a little casino. Like, not always a casino. Like, you're not trained that way, but I'm saying some people that are approaching the market are going there for adrenaline, and they
yeah,
just want the opportunity to make extraordinary gains with a clear risk, and and sometimes a very large risk. And so this is what makes good traders, is that they develop plans and they develop a process from which they engage the markets in a methodical way, with a
mhm.
disciplined way. And that's just to your point. I just wanted to reinforce that you're bang on. There's something for everyone in the markets. You just have to decide what kind of an investor or trader you are.
Yeah, and one thing I would add as well is if you are trading, for example, day trading, make sure you're making a lot of notes on what's happening with your trades, because if you don't actually measure where you're going wrong, you can't improve yourself at all. So
Yeah.
I would add that many people don't measure what's happening. Like why are they taking losses recurringly by taking a trade right at open, and for example at 9:30 at the bell, right? So study yourself, understand why things are going wrong or right, and then perhaps move toward the actions that are eliciting positive outcomes and move
Yeah.
away from the ones that are eliciting negative outcomes.
Awesome. Well, to all our listeners, thanks again for tuning in for another episode of the long and short of it. Nick, it was a great episode, great idea. So thanks everyone for joining us, and we'll catch you all in a couple weeks.
Thanks, guys. Take care.
Cheers.
Cheers.